Okay, so last time we were talking about that how gold can be useless as a currency. So first of all, I wanted to show you different time periods when gold was used as a money or as a currency, or at least gold was backing the currency, and which economic and social structures can be served efficiently by gold or not. So that's why we were checking the gold coin system with the medieval economics, with its terrible linear growth and poor living conditions. And then after that we started to check different time periods when economic growth was already exponential, and thus we were able to see that if economic growth is exponential, then we will have discrepancies between the finite amount of money and the economic growth. And on long time series provided by the Bank of England, we were able to see that, it was not that efficient. But still, they needed something, so that's why gold standard between Napoleonic Wars and the First World War was implemented, where they had finally one central bank, so that was an institutional innovation, that all the money emission was linked to one bank, and also that was a state-owned bank, and also it had license or monopoly for that one, and it was not the part of the fiscal policy, because even during medieval times money was emitted by treasury, so practically they were able to cheat with that one by adding copper to silver coinage. Anyway, during the gold standard, we were able to see that, okay, it was serving efficiently on one hand. On the other hand, it created many problems for central banks, because even if gold can be useful to stabilize the value of the currency against other currencies, but on the other hand, it made a living hell for central banks, because they had to balance out the liquidity demands of the banking system. And to operate as a lender of last resort and to calibrate the interest rates well, they were not able to do that in many cases, because they had to maintain the value of the gold. So it was always a fragile system, but until things were growing and until macroeconomic balance was there-ish, then this system was working. Obviously, everything collapsed after the First World War, especially during the Second World War. So, in the last year of the Second World War, at the Bretton-Woods conference, and after that the agreement, people wanted to come up with something new. Because, first of all, the key lesson of the great crisis between the two world wars was that people or countries cannot go back to gold standard. They tried, but with all the trade barriers, with tariffs, limitations, with all the overproduction and capacities in many different countries, practically they were not able to do that, because their external imbalances were so high, and also many countries had this indebtedness. So within this environment, you are not able to fix your currency to gold anymore, because in this case, investors will run into currency instead of doing consumption, even instead of financing growth with their savings. So in case of Bretton-Woods agreement, they wanted to also modify the institutional background. So they wanted to deal with the problem of public defaults. So they realized that sometimes we cannot finance the state on market basis. So if nobody would like to buy the government bonds, then this country will go to default. So that's why they wanted institutions which can manage such situations. So that was the International Monetary Fund. Later on we will talk about it. So the other was to finance the reconstruction of at least Western Europe. And after that, focusing on developing in other countries. But that was the International Bank for Reconstruction and Development. So that was a sovereign, or at least a bank which was providing project-related loans to sovereign entities. And after that, that was the core of the World Bank Group. And also, what is relevant for us today is the currency system. So since more than 10,000 tons of US or of gold was located in the United States at the end of the war, and since their economy was not in ruins, which was not that common at this time, then it was obvious that US dollar can still be fixed to gold, but all other Western European currencies will be fixed against the US dollar. So this is how they were able to come up with this approach. So and this fix at this, so $1 worth 35 ounces of gold. So obviously it's not grams because they are in the United States, so they cannot use proper measurements. But the problem is with this one that until in the gold standard, if you were not satisfied with your banknote, you were able to go to the central bank and you were able to ask it. Anyone. Private citizens, companies, doesn't matter. In this case, even if the official exchange rate is this one, this exchange rate was only available for central banks. So the French central bank was able to tell the US Fed that, okay, here are the US dollars, we need the same amount of, or this amount of gold. Once they started to ask for gold, then the whole system collapsed. So practically that was much more like an option to convert this one, because we can say that it was a hedged position because they had gold reserves, but it was far, absolutely not enough to cover all the US dollars on the planet. Also, we can say that there was absolutely no role. So there were no limitations for monetary policy, there were no limitations for fiscal policy to maintain this ratio. So it was a great idea, just not that great, because in this case the US dollar had to face with the problem that it's a nation's currency, so it has to meet with all the domestic issues like inflation, unemployment, and so on. So it has a central bank, and the central bank key mandate is to focus on the domestic economy. And also it was a key currency, or it was promoted to be a key currency, so it will be used by everybody else on the planet, and or at least some parts of the planet. But the problem will be that how can you acquire this? US dollars. Obviously, US dollar can flow out only if you have deficit, trade deficit. Because otherwise you will not pay with money for imported goods and services. So it already created this one weakness. And then since there were absolutely no limitations for or against inflation, against fiscal expenditures, against public debt, that's why the whole system, I cannot say started to shake, because it was necessary for taking a decade already until they were able to build up the whole Bretton-Woods system. So until all the Western European currencies were stabilized, until transactions in US dollars were accepted, until transactions in Western European currencies were accepted, because in the first 3 years still there were issues, even within Western European trade as well. And it was working well-ish. The problem started to rise during the 60s. So already in the mid-60s, the US Fed started to warn the US Senate that please consolidate the budget and also the public debt, because there will be inflationary risks. So this is what we can see here. But if we are checking our data from the Madison database again, and last time, then we can see that this western offshoot, so this is mostly the United States, and some Canada is also located in this 27%. So we can see that it was quite reasonable to fix the US dollar to gold, and it was a good enough solution. Even Keynes told so that he is not satisfied because of this discrepancy of national currency and global currency, but unfortunately he died, and on the other hand, nobody was able to come up with better solutions, so yeah. And what we can see here as well, that if we are checking the GDP, okay, it's again the Bank of England database, then we can see that the GDP is still ramping up. So, okay, there were these issues. That was the Great Crisis here. Oh, sorry, that was the Great Crisis here. So sometimes GDP was throwing back, but otherwise it's always following this increasing curve, and you can see that it's already an exponential scale, and still we can see that it's growing in a faster speed. And this is real GDP, so I removed all the inflation from this one. So that was still the problem, that still gold was backing the system, and within this environment it's really hard to do anything like this. Okay, so let's move forward. Because the next problem, as I mentioned, that there were no limitations against public debt. And we can say that, yes, but debt to GDP in the US was shrinking during this time period. So from the Second World War until the 70s, practically it was decreasing from 100% to debt to GDP ratio until 30-something. So we can't say that it was exploding, or if we are checking the US public debt, it was increasing dramatically, nominally, but this is where the Bretton-Woods system will collapse. So we can say that there was an overexpansion, or much overexpansion, what we can see later time periods. But still, the problem is that while before the First World War and even before the Second World War, the US federal budget was a really, really small thing. So still, even if today we are checking that how much percentage of the GDP is redistributed by the federal budget, we will see a way lower number what we can see here in Europe. Yeah, it's usually between 40% to 50%. But on the other hand, they spent a lot of money on different projects. For example, that was I think the nasty dream of any engineers who are working in aircraft designs, because they were able to come up with new, this is only jet fighters. So I was able to collect all the budgets, numbers. So huge amount of airplanes were produced for millions of US dollars. And you can see that they were able to come up with a new design in every year or every second year. And after that, they dropped the platform and they were developing a new one, which was really good because later on many of these developments came to the civil aviation as well. So that's why we have reliable jet engines. That's why we have good computers, which are small. That's why we have good aviation radars. And also that's why we have GPS. Just GPS was not invented in most of this time period. But the problem is that obviously it will create some fiscal issues. Also, the same thing is valid for NASA. So NASA was responsible for 10% of all federal expenditures at the peak period. So when they were landing on the moon and around this period, so in the Apollo era. Which meant that okay, later on, many of these things, again, many of these developments had a strong spillover back into the economy. Just in this case, this spillover was keeping for 1 decade, 2 decades. So at the end of the day, we can say that, okay, GDP was growing, consumption was growing because of this, because they were forced to improve manufacturing, quality assurance. They had to put big computers, which were taking up a room. They had to put it into a small launch vehicle. So they had to develop many things, and not just develop, but also they had to build it and test it. So in many cases, they had to manufacture it 1,000 times and then break them to see how does it work. So we can see that, for example, one Saturn I launch vehicle, which was just delivering things to low Earth orbit, was cost to $767 million. So nowadays, if you are ordering the same capacity, launch capacity from SpaceX, it's $61 million. It's with launch proven or reused first stage, then it's around $30 million. So we can see that things were absolutely expensive. Once, because that was already a public procurement process, so obviously it will be more expensive than by private sector, but also because they had to develop the whole thing. So, and also, obviously, military conflicts, that was also quite expensive. So, at the same time, there were the Korea War, Vietnam War, where they spent a lot of taxpayers' money, also during Bretton-Woods. So, as I mentioned, during the mid-60s, already the US Fed started to warn the Senate that please do something. Just, obviously, politicians are not doing anything until things became really serious. So there was the oil crisis in 1971, and okay, there was the war in the Middle East multiple times, but already it was a really crazy thing to sell oil or any commodities at the unreasonably low price. Because obviously, if we are fixing the gold price to the US dollar at a limited level, then all the other commodities will be undervalued, and it was already an issue. Without war, with war, they had to settle this issue. So, obviously, since they did nothing, then the Smithsonian Agreement was made in 71, when the US dollar was devaluated against all other currencies by 8%. Also, they expanded the fluctuation band from 1% to 2.25%. And also, now the new value of the gold was 100. Obviously, it was not working at all, because still the inflation was ramping up. So at this time period, the annual inflation was at 10% in the US. And still, the US Fed tried to follow this Keynesian monetary policy, which meant that they were fixing interest rates. So for deposit interest rates, you were able to get 3%. For loans, you were able to get a fixed 6% of interest rate loan at 10% inflation. So obviously, this is not a recipe for success and sustainability. So they suspended the Bretton Woods system temporarily in 1973, and 3 years later it was completely abandoned, but at that time nobody cared about this anymore. Because now here we have the stagflation of the 70s. So stagflation of the 70s means that now we have inflation and also economic stagnation. So GDP is not growing, or even if it's growing, then unemployment rate is also growing. So there was a huge need in the US economy for consolidation, and also from fiscal policy level, also it was necessary to consolidate the US. And what happens here, that also there is the price shock in oil, so it was also fueling sometimes the inflation, but it was already backed by fiscal imbalances and other imbalances as well. So they were trying to stimulate the economy with negative real interest rates. Obviously, it was not working, but they tried to do this. So they were trying to maintain low interest rates for 10 years. Maybe it will stimulate the economy. It did not. So, obviously, when you are running a society in stagflation with increasing unemployment, with economic stagnation, and increasing prices, this is bad for the mood. So, if you are checking the cultural impact, so we can go from hippie culture and from Beatles to heavy metal within 10 years or 2 decades until we can go to nu metal, Metallica, and so on. So we can say that it had some benefits, but also issues, because if you are checking the lyrics, then they were not that happy at that time. So, okay, but European politicians, I mean Western European politicians, were not that happy when they had to operate under Bretton-Woods, especially during the 60s, because they realized that so at the beginning everybody was really happy when US dollar was flowing in, because oh, it's really good, we can fill up our international reserves, we can build up our reserves, it's like gold, but it pays us some interest, so it's much better. But during the 60s they started to realize that okay, still they have this foreign exchange surplus and also trade surplus at the same time, but now the US dollar started to become excessive. So Charles de Gaulle from France tried to convince the US Fed to convert some part of their US dollar reserves to gold, but luckily after that in 1968 he lost the elections, so after that this agenda went off the table for some years, but we can see that already there were issues. So already in the 70s, Western European politicians were absolutely fed up with the situation, so they wanted to come up with something for their own. And in this case, they wanted to build on the requirements of the optimum currency area, which was already developed in the 60s by Mundell. So Mundell said that we can introduce a currency, or at least we can fix different countries' currencies if they are meeting the following 7 requirements. So first of all, we have to deal with the imbalances. How can we deal with the imbalances within this economy? Integration. First, we need labor mobility, because there will be regions where, or countries or regions within the countries where economic activity is poor, unemployment is high, so that's why we can put these people in places where there is a scarcity for this resource. Also, capital mobility. It's another must feature, again, because in some economies where, or some regions where we can find economic growth, there is a scarcity for, or demand for capital, while in other places they have a lot of savings, but maybe not enough projects to invest into. So practically the two requirements is just to improve efficiency, it's to deal with excessive capacities or capacity demands. The third one is production diversification. So obviously the output should not come just from one economic sector, industry, or just from one product, because in this case the whole system would be absolutely dependent of this product's price. So diversification is much better. The problem will be that, okay, even if you are diversifying, so some part of the output is coming from real estate business, some part of this output is coming from automotive sector, some of this output is coming from so some other capital intense investment. let's say, healthcare. The problem will be that if we have a financial crisis, all these different industries will be affected because in case of an automotive sector, fleets or fleet managers in logistics sector, they are leasing their fleets. They are never buying it for cash. They are always using lease contracts, or at least they are using some kind of a loan. So if there is a scarcity of lending, then they will be in trouble. Also, the same thing is valid for real estate business because most of the demand is backed by loans, and in any other capital-intense industries, we will have the same issue. So even if this production diversification will create a smoother business cycle for us, this one is not immune against any financial crisis, any banking crisis. So this was missing from Munda's ideas because obviously this came only after the 2008 and 10 global financial crisis and then the sovereign crisis in the Eurozone. Also, we can see that similar business cycles for top participant countries, obviously because otherwise we are not able to calibrate the monetary policy well, and fiscal transfer mechanisms to redistribute some of the money from rich regions to poorer regions to maintain. Because every economic center needs its environment. They need markets. So we can say that, okay, we have really rich regions in Western Europe, but still they need markets around them because otherwise they can be really rich. Just if they are not able to sell their products, then they will be also in trouble. And homogeneous preferences, ideologies, obviously because politicians should sit down to the same table and talk with each other. So at least similar-ish ideologies. So they should not hate each other that much. And solidarity, in this case, it means that we need funds to mitigate and to resolve crisis situations. Again, people were, I think, not understanding the importance of this last thing until the sovereign crisis of the Eurozone, when this solidarity meant that they had to create the European stability mechanism, which meant that they were creating a fund which had to issue 381 or 2 billion euros to stabilize Portugal, Spain, Cyprus, Ireland, and Greece, yeah, obviously. So solidarity is expensive in many cases, so that's why we will talk about it later on. And after that, it will be really funny to see that how OCA characteristics and requirements are met in the different levels of the European integration. Because at the beginning, when after the Second World War, after 2 World Wars, French and West German politicians realized that maybe they should share their coal and iron with each other. So they created the Mountain Union to liberalize the steel industry among each other. Then it was just focusing on trade. And when it was deepening during the 70s, we can see that now they had some budget. Even if this budget, even today, it's like 1% of the whole GDP of the EU. So yeah, this is not much money. From Hungary, yes, it's a lot of money, but otherwise, from a robust economy, we can say that it's not much. But if they are not meeting 1 or 2 requirements, then during the next crisis, they will be forced to develop this or that arms. So let's go through all the boundaries. So at the beginning, obviously the great idea was to fix everything to gold, so that was the gold standard between the 2 world wars. Then it ended with the First World War, but practically it ended with the Great Depression when they tried to go back. So obviously it was not the ideal solution. So second great idea was to fix all the currencies against the US dollar and fix the US dollar to gold. Then this created huge inflation and also trade imbalances remained there. So, next thing was, let's fix all the currencies against each other. So that was the snake in the tunnel, which was working for several months. I don't know who had this bright idea, but so let's take all the nine currencies. Let's find all the possible combinations of these nine currencies against each other, and then let's fix all the currencies against each other with 2.25% fluctuation there. It was not working. Maybe it was collapsing within 3 months. So West German mark was jumping out, so it was appreciating, the rest was depreciating. So what remained, that they had a West German mark zone with Denmark, without Austria, but with all Netherlands, Belgium, Luxembourg in it, because they were able to follow the appreciation, and Italian lira and French franc was depreciating. So that was absolutely useless. So after that, they were able to come up with the next great idea, which was much more reasonable. So that was the European monetary system, which is a great name, but in the end of the day, it meant that they created the basket currency. So that was the European currency unit and ECU. So ECU is the French pronunciation, so we have an English term with French short term for it. So that's why this stupid ECU and European currency unit pair. So in this case, they already had 12 participating economies because the European integration was growing. And in this case, they were taking, so they created a weighted average of the different currencies. So they were taking their relevance from foreign trade. So West German mark had nearly 30% weight in the portfolio. France had 20% in the portfolio. Italy, Great Britain, Belgium, Netherlands had around 10%, sometimes more, sometimes less. But they created this artificial basket currency, and after that, each currency had to be fixed against this artificial currency by this 2.25% fluctuation band. If I remember well, there was one example or one exemption. So Italian lira had 8% fluctuation band, but nobody cares about that one because it was depreciating usually. And in this case, it was a really useful tool for stabilization because if West German mark was appreciating by 1 unit, ECU was just appreciating only by 0.3 units. So it was easier to follow by other central banks. But still, the problem is that in this case, if you are doing this, then your whole interest rate policy will be the function of this monetary or exchange rate regime. So the problem is still there that, oh, we stabilized the currency, just now the central bank is still not able to focus on the needs of the domestic economy, on the inflation, banking system stability, anything like this. So who cares about growth, who cares about unemployment, who cares about inflation? We have to stabilize the currency, which is crazy. But they were able to maintain this. And also, what we can see here that during this lifespan, so it existed until practically until the late 90s, so until the introduction of the euro. So I was writing here 1992, but it was existing later on. Just in 1992, people created the Maastricht Treaty, where they created all the roadmap towards the introduction of the euro. So after that, practically nobody cared about the existence of the ECU because that was already a temporary measurement. And also the EMS was really simple because we had no central bank, we had no pooled reserves or anything. So there was no institution behind this. They just had an artificial currency unit. But it was also really interesting because, okay, they used the ECU to determine the budget of the European Union and any European Union or European communities related projects. But also, as a citizen, you were able to buy ECU, not in paper money because they never issued any money, but you were able to open bank deposits in ECU. So I remember that when I was a child, I was able to see the exchange rate for ECU, and also people were able to do that. It was not that common, but yeah. So if you prefer infographics, I created this beautiful picture many years ago. So in this case, we can see the evolution from gold standard towards Bretton-Woods and the free floating after the collapse of the Bretton-Woods system. So we can see that gold will disappear from this. And after that, when euro was introduced, then practically all the other currencies were disappearing from the continent. Yeah. So they created the roadmap in the early 90s. In the late 90s, they were able to introduce the euro first as just as a digital currency, and after that, within a year, they removed all the unnecessary national paper monies from the market. And everybody was celebrating, and in this case, obviously, the question is that what can possibly go wrong? Because they created the European Central Bank, but during the next presentation, I will talk about the European Central Bank. And even next week, we will talk about the European Central Bank, how it had to improve its crisis management abilities, how it had to improve their instruments to meet all the problems and to manage all the problems of the 2010s. So just to create a single currency and the currency union, it's absolutely not enough. Because now people were able to see that also fiscal discipline, fiscal rules, and also risk mitigation and crisis mitigation funds are necessary. So we need them. So even if they were creating this stability and growth pact and other things, practically when it was up to Germany or France in the early 2000s when they were in recession, then they were not punished by anyone. So that was the key moral issue, that if a big member state was affected, and then they were not punished. So after that, we cannot blame Greeks and other member states who were also not dealing with these requirements. So obviously, when European sovereign crisis happened in the 2010s, then they started to deal with all the fiscal rules, but I don't want to talk about this one. But still we can see that, yeah, so there were issues, but later in the future class I will talk about it. Yeah. And what we can see here, that what is the share of from public debt in 2019. So if you are looking on for different countries, so with yellow, we can see Germany, 20% from the overall public debt. We can see that, okay, COVID was changing it, but not that much. So let's say still around 20%, or sometimes it was even shrinking. Then we can see Spain, which had to be bailed out during the sovereign crisis, but it's still just 12%. Or, for example, when we are looking for Greece, which had to be bailed out a lot, it's just 5% of the overall public debt. So we are talking about small shares from the pie. If we are looking for, what is this? Yeah, France. So France had this 23% of share from the public debt, so it's a bit bigger than Germany. And also Italy, 24%. So if you are looking for the countries which are circled in, then these countries were bailed out during the sovereign crisis of the 2010s. But I'm always afraid of Italy. So Italy unfortunately combines aging society with poor economic growth, decade-long poor economic growth. Practically they are not growing since the 90s. Only northern Italy is growing, but total as a whole, the economy is in stagnation. And this is always a recipe for disaster. So that was also the same case for Portugal, just Portugal is really small. But in case of Italy, so if something happens, something wrong happens with 24% of the overall public debt of the Eurozone, then we will have a nice crisis. So that's why if anything is happening, then usually politicians are happily do something to mitigate the risk and avoid anything which is related to the Italian public debt. So this is not a Greek case.